Good morning, everybody. Hey, welcome to Wednesday, June 12th. About almost halfway through the month, almost. We're getting there. Hey, but I want to point out today that after a couple good days on the market, things are heading the other way this morning. And Dave and I will discuss that. There's not a whole lot else going on as we kind of look at the markets today in terms of earnings. We're really getting towards the end of earnings season. But before Dave gets on and we kind of look at the charts there, I did want to remind you again of our free report that we have on market corrections, and make sure that you get a copy of that um, before it's too late. We want to make sure that everybody is current and understands what's happening in the markets today. And so to get your free report, all you have to do is text the word market to 863-285-3815. Hey, Dave will be with us in just a moment.
5.7 Light FM. Hey there, it's 8:39, and that's 21 before 9. Time to check in and find out how Wall Street's doing this morning. We're kind of into the doldrums right now as far as news is concerned because, well, we're done with pretty much all of earnings season, and the economic reports are coming out close to being what folks expected, although the occasional miss and whatnot. Phillip Statler's in his office at Statler Financial Services in downtown Sebring. Phillip, I'm almost looking for a presidential tweet to have something to talk about.
Yeah, it's we're definitely dwindling down towards the end of earnings seasons for sure, because there's just not much left to talk about when it comes to the earnings front. I think we had less than 11 earnings come out today. So just not much there, and there's not much economic news that's really moving the needle today.
Yeah, it's on the quiet side. We did talk about before we went on the air about the interest rates on bonds. Yesterday, we both made note of the fact that bond yields for the federal bonds were heading back up again, and that generally would be an indication that folks were looking at equities a little bit more favorable. Well, guess what? We're back down again. Everything's down at least a couple of basis points this morning, meaning we're flying back to safety again, aren't we?
Yeah, we really are. We are trading down again, and we've kind of got two different scenarios here. If we look at the 3-year, 5-year, and 7-year treasuries, they're all trading lower than the 1-year T-bill. And if we look at the T-bills, the 1 month, 3 month, and 6 month are all trading higher than the 1 year. So we've got definitely some inversion going on in there.
And that sounds like just, number geek stuff to the layman out there, but that's an indication of a couple of different levels. Number one, it tends toward being a harbinger of recession, but it also is an indicator as to where some of the smart money thinks that the volatility range of time frame is going to be. The 3 month being higher than the 2 month, the 2-year, and the 5-year kind of tends to indicate that we got some smart money out there in the market saying that they're going to put their money where it goes nowhere for a little while just to be safe for that kind of a time frame.
Well, and that's true. And then you also have one of the big headlines. I didn't read the article because it's just a survey, but corporate execs were surveyed by Duke University, and they are fearing a recession in 2020. That's just a big headline.
Yeah, you and I have both been saying we're overdue for one, although nobody looks forward to one, do we?
No, nobody wants a recession, but you and I talked yesterday after we got off there that there is a business cycle, and that business cycle is going to come no matter what we want to do or how we want to play it. There is a cycle, and we go from expansion to contraction, and sometimes that takes 10 years, sometimes it takes 15 years, but it happens, and so eventually we know we're going to get that part of it.
Which kind of plays into the line that you've been using for a long time in terms of advice that a good investor, especially one that's less than 10 years from retirement, needs to have that proper strategy to stabilize one's retirement in the event of said recession, right?
That's right. The closer you get to retirement, Dave, the more important it is that you've got some exit strategies and that you've got the proper diversification. Not that fancy pie chart, but the diversification between what has your principal protected and what principle do you have at risk. That's the first really thing that needs to be accomplished.
Yeah, understood. The big money guys in the bond markets are probably a good example to look at. They're moving some of their money over into a stable instrument so that they can play with their gambling money on the equities, but they've got a stability element to their portfolios, and these guys are playing with billions of dollars. Those of us with only a few thousand probably ought to use that as a good lesson, right?
That's right, and you can see they don't really care what they're going to make on the Treasury side. They're there because they know they can't lose their money. The government's going to, whether they have to print money or not, they're going to get the principal back. And so that's that diversification between safety and principal. And unfortunately, we don't see that a lot out there.
Without a doubt. There were a few numbers that came out of the federal government. It was a data dump, but it might be better described as a data trickle. The Consumer Price Index reports came out, and if you don't like inflation, this ought to be pretty good news because the CPI in May was up 0.1%. That revises the annualized rate down to 2% on the nose. The core was also zero point 0.1. I gather that was a miss, and because we're playing good news, bad news, good news, that's not pleasing the markets very much.
Well, it's not. It's not really giving it any rise one way or another. It's actually the futures have kind of improved a little bit since that number's come out. Not a whole lot, but any improvement off of red is good. And so, but it was a miss. We expected in the core CPI to be 0.2%. It was half of that. It was 0.1%. And so, it just again goes to slowing down the economy. That just shows that there's some slowdown there.
Absolutely. And the slowdown tends to indicate less of a reason for the Federal Reserve to look at an interest rate decrease as we start getting into that slowdown. You don't know what the indication are. With a slower inflation rate, that would tend to make me think that maybe a decrease would be more in the offing, wouldn't you think?
Well, a couple of the headlines, a couple of the big banks are, everybody thinking it's going to be coming up at this next meeting. They're saying don't expect a rate decrease until possibly September at the earliest. We'll see what happens when the Fed actually meets. Hey, but on another side note, we talked a little bit yesterday, I think, about mortgage applications and mortgage rates being the lowest they've been in 2 years. Well, I
Yeah.
got some quantifying numbers now. The applications for mortgages soared 27% last week.
Wow.
Yeah, pretty
That was
substantial.
something we haven't seen for a little while with the refinance market refiring, right?
That's right, and it's 41% higher than the same week a year ago.
That's fascinating. Yeah, I haven't seen what the prevailing mortgage rates are like. Have you seen a number lately?
I did
know.
actually. I dig down deep and found some today. It seems it's decreased to 4.12% on a 30-year fixed.
That is a nice number. That's enough to encourage a few refis down the line. I was lucky. I refinanced mine right at the bottom, and I got 3.75. But there's a lot of 4.5% mortgages that are starting to get into the range where, maybe refis do make sense now, right?
Exactly. You have to run the numbers because there's always an expense when you do a refi. And I've always said the rule of thumb is you want at least a 1% better interest rate than what you currently have at a minimum. And then the other thing is you need to be making sure you're going to stay in that house for about 7 years to help recover some of that cost.
Absolutely, because it always helps to remember that you're also extending the amount of time it takes to pay off the note unless you do something like a 15-year fixed or something.
Right.
The other government figure that came out this morning was wage increases. I didn't get a chance to ask you before we went on the air whether it was a surprise or not, but wages in the government reports in the private sector up 0.2% in May. Everybody wants to shoot for 3. That doesn't get us to that point. Was the market expecting better or worse?
Dave, my economists don't follow that one. They don't get a consensus estimates on what they think that's going to be. So I don't know which way that fell from what people think it should have been.
Okay, from a personal standpoint, shooting for 3% on an average, a 2.5% increase would be a bit of a miss. I don't know what the official was. And you mentioned that we don't have a lot going on in earnings season. I know you got one report out this morning, don't you?
I do. I have Dave and Buster's, the entertainment restaurant where you can go as an adult playground, right? You go play games. They have a bar. They have a restaurant.
Chuck E. Cheese is for grown-ups.
There you go. They missed estimates by a penny a share. Revenue also was short of what was forecasted, and their same restaurant sales declined by 0.3%. And then on top of all of that, they lowered their full year forecast. So that's not a good thing for Dave and Buster's. They're down almost 18% this morning to $42.35 at this point in time.
They kind of hit the trifecta of misses this time, didn't they?
They will, and that will at the open. If they open at that spot, they will be a new 52-week low for them.
Gosh, I guess showbiz for kids doesn't necessarily work for grown-ups all the time, right?
No, I guess not. It's one of those things. Hey, but I want to make this comment before we move on, and that's Etsy. They're the place where you can go online, order stuff from individuals, and they'll go make it for you type thing. They're up 100% in a year. And this person is a technical person, chart person. They say there's more room to run. Now, whether that's true or not, nobody really knows. But that just shows you that there are some stocks that are having a pretty good year. And they compared that to Amazon. Amazon's up 11% for the year.
Cool. I read in the magazines and the tip sheets all the time about the growth of the quote-unquote gig economy, the folks who do stuff on a job shop basis, on a project basis. Etsy kind of plays into that trend, doesn't it?
They really do. You're absolutely right. I know my wife's used them a couple times to order like invitations where they'll do the calligraphy and that kind of stuff. So a popular place for people to order things like that are kind of artsy.
Cool. Another business plan that I didn't expect to work, that is, evidently. Setting the table for this morning, it was a day on Wall Street yesterday. You got to say it wasn't good because it was off, but 14 points down on the Dow is pretty close to flat. A half a point down on the NASDAQ is even closer to flat, and down 1 point on the Standard & Poor's is close enough to government work to flat as well. Can we stay flat this morning, Phillip, 45 minutes before we start?
I guess it depends on your definition of flat, but we're down about 0.2% for most places. The Dow's down 54. The S&P 500 is down $6. So both of those about 0.2. The NASDAQ's double that, down 0.4%, down $30 to start the day. We've got gold and silver both up a tad. Gold's still at like $1,340 an ounce. Silver just cannot get above that 15. It's at $14.81 an ounce. And then we got crude oil sliding significantly this morning, down 2.75% to $51.81 a barrel.
Yeah, that's a pretty substantial drop. Even gets out of that trading range we were talking about earlier, doesn't it?
Yeah, it does. And so maybe we'll see some decline in gas prices.
Wouldn't complain in the least, even with my high-mileage car. I like it cheaper. Overseas markets, I guess Asia got sick of being happy for a couple of days. The Chinese markets are off markedly this morning, and the European markets also trading down and following suit midway through their day. Phillip, somebody needs some advice to be able to do that stabilization we were referring to earlier on retirement. You got a lot of tools to help them out. How do I find you?
I do, Dave. We have this report coming out that's on market corrections and what they really mean to you. A big thing I think that's important, and all they have to do to get it is text the word market to 863-285-3815. It's that simple, folks. Just text that word market to 863-285-3815. Dave and I have been talking quite a bit about, hey, it is time. We're heading back up. Now's a great time to make sure you don't have too much risk in your portfolio. Call, get your free financial x-ray visit, and you can do that by calling 382-0037. Catch us every weekend for the Statler Financial Radio Show, noon on Saturdays, 10 a.m. Sunday mornings on News Talk 730 a.m.
All righty, that streams on newstalk730am.com, and I might have an announcement about how folks can hear this program on streaming before long as well, Phillip.
Oh, man, I'm excited now. I can't wait for that one.
Cool beans. I will catch you tomorrow, and you have a pleasant day, sir.
Thank you, man.
Thank you. It's 105.7 Light FM and Statler Financial Services, Phillip Statler.
Again, I want to remind you that we have that free report that I mentioned on the air, understanding market corrections. I think it's vitally important. We've seen a couple good up days, but now we're seeing the fall off again. So you need to understand what's happening, and the closer you are to retirement, the more important that is. So all you have to do to get your free copy is text the word market to 863-285-3815. Hey, guys, have a great day. I appreciate you tuning in and listening today. I look forward to speaking to you again tomorrow.